out, it did take a different approach. So as opposed to the normal IPO approach, it pursued a direct listing, which occurred last Thursday. We were not one of the financial advisors, and so we're clear to publish when we would like. The financial advisors, as I understand it, Kelly, are sticking with the normal 25-day restriction, and so I think they've still got a few weeks until they can initiate. But I'm unencumbered, and so able to start talking about the stock.
You know, the more I hear about this model, the more it just sounds like an IPO by another name. But anyway, let's put that aside. So you did initiate coverage. How do you describe its performance? Because we're talking about its performance relative to the reference price set by the New York Stock Exchange. Is that a fair enough assessment? You know what I'm saying? What ends up being the right way to talk about the number at which this company debuted?
Well, that's a good question. There's not a great benchmark. I mean, I guess Spotify is really the only other company recently that pursued a similar model. Yeah, the reality is it started trading in the high 30s, and I think that's probably the more realistic benchmark in terms of price performance. You know, what we do know, though, is, looking back at the financial results of the company, they've put up tremendous numbers, right? Growing, north of 80% in fiscal 19. We're forecasting close to 50% this year, and that's really the key to the stock is the business momentum. But the price performance and what the right starting point is, that's a debatable number.
Is this one where you don't care that the company isn't making money?
Well, you never don't care. But look, this is a stock that you want to own for the long term. We think it's a core software holding. It operates a disruptive technology that's really kind of revolutionized and taken the team messaging and collaboration market by storm. And so it's more about that revenue growth, the business momentum, and ultimately the long-term margin profile that we think actually stacks up well relative to the broader software group, despite the valuation.
So tell us how you arrived at a $44 price target.
Well, that's a good question. We're using 23 times fiscal 22 revenue, which by most historical measures would look steep. And of course, it's trading at roughly that multiple on fiscal 21, which would be analogous to kind of calendar 2020. And some of the other high multiple SaaS names are up in that range. Names like Okta, Zoom, one of the other recent hot IPOs, is actually trading at a multiple above that. So certainly above the normal historical range. But again, Kelly, for us, it's more about the business momentum and the opportunity for potential upside to estimates as you move forward.
And when do you see profitability?
We have profitability several years out still. And the important element is we expect profitability measures to improve. So we're looking for an earnings loss of 42 cents this year, dropping to an improvement of 17 cents the year after. But a couple of years out before they hit profitability and positive free cash flow.